Hey, it's Dan Moralez. This is Homebuyer Radio. This week, what I want to talk about I feel like I'm going to do a series here just talking about credit scoring, credit utilization, things that can pop up on your credit report that can pose a problem or a challenge that oftentimes you as clients may not be familiar with. This week, what I want to talk about credit utilization. Okay, and what credit utilization is when you, let's say, have a MasterCard or Visa, let's say credit card. If you have a $5,000 limit, it's the percentage of that limit that is currently being utilized. Okay. Now, what I mean by that is if I have a $5,000 limit and if I have a $3,000 balance on that $5,000 limit, that means that 60% of my available credit is being utilized. Okay. Now, whenever you have a utilization that is north of 50%, it has a negative impact on your mortgage credit score. Okay. Ideally, the sweet spot would be to keep it less than, probably 25 to 30% if you can, because that has the smallest impact on your credit score. Now, a lot of times you may pay your credit card off in full every month when you get your statement. Okay. Well, what is used when they calculate, if you will, that credit utilization is whatever the balance is when your statement is issued. So I have a number of clients that may have, let's say, a $5,000 limit. They travel for work. They have to put a bunch of expenses on their personal credit card, and then they get reimbursed afterwards, and they pay their balance in full, if you will, every month. Well, the problem with that is that balance of, let's just say, $3,000 that's reported on the credit report is what's going to be used when they do that credit utilization, if you will, calculation, and that negatively impacts your mortgage credit score, even though you pay it off in full every month. So even though you pay it in full every month, whatever is being reported on your actual statement is what's going to count against you when they calculate your credit score. So ideally, if you have the ability to pay it off prior to the statement being cycled, that usually is best. So let's just say I have a $5,000 credit limit. I have a $3,000 balance. I know my statement cuts on the 10th of the month. For a lot of credit card companies, you can log into an app or to their website. If I know my statement's going to cut on the 10th, maybe I log in on, let's say, the 5th. I pay that portion of the balance that I intend to pay, and then I can drive down my credit utilization number because at the time that my statement cuts, then my balance is significantly lower, which, of course, is more favorable for you. Now, this really impacts a lot of clients who are self-employed. I have a lot of clients who are self-employed. Part of how they fund their business operations is they use credit cards, and then they pay them off every month as they go. I've had a couple of clients where we've had to, kind of take the same approach where it's like, okay, log in, pay that balance down before your statement cuts so that we can raise your credit score and get you more favorable mortgage terms. So just because you pay that balance in full every month, you need to know that credit utilization can impact you negatively as part of the mortgage process. Now, for a lot of folks, they tend to see, and I'm going to, talk about this, and I've talked about this a million times before, is they see that their, Credit Karma score is, 750, and they think that that's the same as what their score is when it comes to getting a mortgage, which, of course, your mortgage credit score is not the same as Credit Karma. It's not the same as, Credit Sesame. It's not the same as your bank's, let's say, score that they give you. I know a number of banks will give you a free credit score. Capital One does one, Discover Card. You can get a credit score from all these different sources. None of them are your mortgage credit score, okay? So they don't mean anything when it comes to the mortgage process. They do give you an idea of what your overall kind of general credit health is, but they don't coincide with your mortgage credit score, which means that, it really does nothing for us when it comes to that overall, final mortgage credit score, okay? Now, I recently had a client, and I like to tell stories as part of this, in all honesty, when it comes to credit scoring, I could tell stories for hours. I don't know that you want to hear them, but I could tell them for hours. I recently had a client. He came in. We went through this pre-approval process, and he's like, oh, no, my score is higher. This is wrong, blah, blah, blah. So I explained to him, why it's not wrong, why his Credit Karma score is not the same as his mortgage credit score, and so on. Okay. And this person, just didn't want to hear it, and so went through and we a couple weeks later, no, they fixed this. My score went up, blah 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 blah, and so we went through and we ended up getting an updated credit report, and lo and behold, his score had dropped even more because of something else that had reported on his credit report. So because he didn't want to listen to what I was telling him, what he managed to do is he managed to end up with a lower credit score, which unfortunately for his sake, impacted him negatively when it came to his overall rate and terms. So, when we guide you through this process and we try to help you understand that there's a reason why we do things a certain way, or there's a reason why we suggest certain things, the reason we do those things is because, after doing this for 29 years, I've learned a thing or two about this process. I learned a thing or two about how to help position you for the best overall mortgage outcome, where unfortunately, a lot of times people think they know better than us, or they've read something on the internet. Hey, let me help you out there, guys. There's a lot of stuff on the internet that is garbage. Okay, as somebody who is always looking at what else is out there, what other information is out there, there is so much misinformation. It is not even funny. And I actively participate in some mortgage groups that are out there on Facebook and different social media areas where they're for industry professionals. Okay, and it's amazing to me the questions that people ask in those groups that, in my mind, are truly just basic, stuff that a loan officer should know. And it's like, how can you possibly lead or guide your client to a good mortgage process when you don't even understand basic parts of the lending business? And these are a lot of the people that we compete with. So not to toot our own horn, but to toot our own horn. We actually know what we're doing. We're experienced. We're going to guide you through this process the right way, so you don't end up with the wrong loan structure or the wrong answer, or jumping through a bunch of hoops only to have things kind of blow up in your face. So, to go back to, the credit utilization stuff, okay, I have another client that I ran into a transaction recently. So this client, they sold their house, and they decided to come and get pre-approved at the advice of the realtor. They stop in our office to get pre-approved, and, they find out that, your credit score, while it's doable, it's lower. And here's, 5 or 6 things that you can do that would raise your score, that would get you a much more favorable outcome. Well, the problem is these clients had already sold their house. They didn't start this process soon enough. And again, there's a number of episodes I've done talking about that. Start this process sooner. Why are you waiting so long to start the mortgage process when you could, you can get a lot of answers, right? Like, why would you go through and sell your house when you don't know what you qualify for the next property? You don't know what the payment is going to be. You don't know any of those financial circumstances, but you went ahead and you sold your house, and you're going to commit to buying the next house without knowing anything? Like, that doesn't make any sense at all. It's really important that you go through and you get a good read for what those options look like, so you can go into that next transaction with your eyes open and having a good, clear understanding of what to expect in this process. So in this case, this client had a number of credit cards, high credit utilization, which drove their score down. We were able to kind of help them understand that when they closed on the sale of their house, they had to very quickly pay off some credit cards so that they could drive their score up. Driving their score up is going to save them a ton of money as far as mortgage rates and terms and so on. The unfortunate part for them is now, once they've sold their house, there's this big rush to hurry up and pay off these credit cards so we can get them rescored before they need to close on the next house. And that creates a lot of stress for these clients. And they're awesome people. Like, they are just two of the most wonderful people. And I hate it when clients feel stress that, was avoidable, right? And that stress was avoidable had they started this process sooner. We would have been able to coach them on exactly what needed to happen. They could have gone into this, with a little less stress, But unfortunately, in this case, because we didn't get, the opportunity to meet sooner in this process, they have some stress right now, right? They have some stress in going through and getting all this stuff done and getting us the documentation we need so that we can get them rescored, which is, of course, going to save them a bunch of money. And it just makes for a lot of stress that, in the middle of moving, that's kind of the last thing you want to do. do is have a bunch of stress. You have enough stress moving, but then now you're going to have stress on top of that, having to get all this documentation together so that we can try to save you some money. The other alternative is, of course, just to, let your credit score stand how it is, and it costs you thousands of dollars more because you didn't start this process earlier, okay? So credit utilization is probably one of the biggest, hurdles that, or I should say one of the biggest areas where clients are impacted in this mortgage process, because if you have typically greater than 50% of your balance being used, is going to definitely hurt your credit score. Ideally, if you can keep your, maximum balance to 25% or less of your credit limit, that's going to be ideal for you. So in other words, if you have a $10,000 credit limit and you have a balance that's north of $5,000, that's going to impact your credit score, okay? Ideally, if you can keep your balance to less than $2,500, that is going to be better for you than if you had a higher percentage of utilization, okay? Because that credit utilization is one of the quickest and fastest ways to get a score up for a client, okay? Is to be able to drive that down when you have the ability to do that. Now, not everybody has the ability to pay that balance down, which means that, unfortunately, it could end up impacting you long term. So this week, just talking about credit utilization. How can you drive that down? Ideally, keep it to less than 25% of your limit, because that's going to be the most favorable for you. Now, I have some clients that will pay it to zero every month, right? I pay my my statement in full every month, so that shouldn't really impact me. That doesn't mean it won't impact you. Okay, I'll give you another story. I have a client that travels a lot for work. This client gets reimbursed from his company for all of his travel expenses every month. So in this case, he has a $5,000 credit card. That $5,000 credit card can have a balance of $3,000 to $4,000 every statement, because he does a fair amount of traveling, and then he gets reimbursed and pays that statement in full every month when he gets his money from his company, okay? The problem with that is when that statement is cut, it's going to report a balance of $3,000 to $4,000, which makes it look like he has 60 to 80% of his credit card being utilized, or a balance of 60 to 80% of his credit limit, which makes it look like he's, tapped out or maxed out, if you will, okay? Now, even though he pays it in full every month, the credit scoring model isn't one that, is recognizing that, so it doesn't make any impact to him when it's all said and done. So one of the ways that we've been able to work with some clients who have similar situations like that, where you pay, let's say, a larger balance in full every month, is to kind of coach them to find out, when does your statement cut? So if your statement cuts on, let's say, the 10th of the month for your credit card, and you've already been paid from your employer to be able to pay that balance in full, maybe what you do is you log in to your credit card provider's website or through their app. And if your statement cuts on the 10th, maybe you log in on the 5th, you pay that balance down on the 5th, so that way when your statement cuts on the 10th, your percentage of credit utilization is significantly lower than what it would have been if you didn't make that monthly payment, okay? So that's a free trick, and it's one that, if you pay your balance in full every month, it's a great way to, I don't want to say manipulate your credit score, but to have your credit score really report more accurately as to what you really do have for credit utilization. Because, truth be told, if you're paying your balance in full every month, you don't have 60 to 80% utilization. Maybe you have 5% or something like that. So that's one way that you can, if you're somebody who's paying a balance in full every month, and you travel like, my client did there, that's one way to kind of help to, control your credit score and help to get that score as high as possible. Now, higher the credit score, the better the terms you typically get. Now, that can impact mortgage rate that you get as far as credit score can impact that. Can also impact your cost of mortgage insurance, too. So if you're doing a down payment that's less than 20%, that can definitely impact your cost of mortgage insurance. So the higher the credit score you have, the better the overall terms when it's all said and done. Okay. Hey, I'm Dan Moralez, America's Mortgage Man. You can find me online at danmoralez.com. That's DANMORALEZ.com. My phone number is 616-931-4629. My NMLS number is 709-729. And of course, Northpointe Bank is an equal housing lender. Hey, do me a favor. If you enjoy this podcast, write a review on iTunes for us. But most importantly, the best thing you can do is if you are going to buy a house, we would love to have the opportunity to work with you. I do lend throughout the U.S., the majority of the 50 states, and we offer the majority of our products in the majority of the states. And in the rare circumstance that you are looking for a product that we don't offer in a state that we don't have it available, I have a group of friends nationwide that I can definitely get you connected with that are also competent and know what they're doing as well, too. So love to connect with you and help you out if you are in the market. If you have a question, getting more and more questions from folks as well too. Love that. We're going to do some Q&A stuff here in the weeks to come up. I really want to spend a few weeks on credit. So if you have a question specifically that's related to credit, credit scoring, credit issues, and so on, maybe it's collections or judgments or foreclosures and bankruptcies and all that other stuff, I would love to have your question. I'm going to have a special guest who works with a lot of clients that have impaired credit, where they have a lower credit score. And what are some of the things you can do to kind of repair your credit health and get you back on the right page. Sam Parker from My Credit Guy is going to be joining us here within the next week or two. And Sam is just a wealth of knowledge and experience when it comes to working through some of that stuff. So looking forward to having him on the podcast. But if you have questions in regards to credit, repair and good stuff like that, that would be something that we'd love to have you email us as well too, whether it's credit scoring or whatever, anything that's kind of credit related. Love to get your questions and see if we can't maybe cover some of that stuff in the weeks to come. Also going to be interviewing some local real estate agents who are knowledgeable in the greater West Michigan market, and knowledgeable in regards to kind of the market as a whole, nationwide, to be able to give you some color as to what the opportunities look like for those of you who are still waiting to buy. I think the cost of money is good, and I think prices are awesome. So I think you can have a great opportunity to be able to jump in back into the market if you are maybe on the sidelines or got in the sidelines for a while. So again, Dan Moralez here. Thanks for listening. Make sure you share the podcast and definitely write us a review. Talk to you soon.